Hi everyone, we are nearing the end. This is our next to last chapter. We are covering chapter 21 tonight, which is cost, volume, profit analysis, also known as CVP analysis. So we're going to be looking into types of cost behaviors in relation to production and sales volume. So we're going to start by looking at how can we identify cost behaviors? So again, this is another management function. So they're going to use this cost, volume, profit analysis to help them make predictions. So they give some examples here of some of the predictions they might be doing. But when we're trying to plan the company's future activities, it's important to make sure that we have a plan in place. So this planning starts out with how do we predict the volume of activity, the cost that we're going to have, the sales we're going to make, and the profit we're going to earn. So the cost, volume, profit analysis helps us do that. So it's going to help managers predict how changes in cost and sales levels affect profit. And it's going to involve computing the sales level at which a company neither earns an income or incurs a loss. This is called the break-even point. So because we're trying to get to that, we want to know exactly what do we need to do to break even. And then we can aim for higher to have a profit. And we want to make sure we avoid that lower to avoid a loss. So let's look at some of the types of costs that we can have. So our first one is a fixed cost. A fixed cost means that it remains unchanged no matter how the volume and activity changes within a relevant range. And that's true for all of these. So an example that they show here is $32,000 in monthly rent that's paid for a factory building. They pay that $32,000 every month, and it doesn't matter how much they make. They could run for an hour a month. They could run for 160 hours a month. They could run for 300 hours a month. The amount of rent they pay has no bearing on that. So the rent is the same every month, no matter what the level of output is. So that is why it's called a fixed cost, because it doesn't change. So some examples of fixed costs include depreciation, property taxes, office salaries, and a lot of service department costs, as well as rent, as we just saw. So one thing to make sure that you keep in mind is when we talk about a fixed cost not changing at the level of production changes, that applies to the total dollar amount. It's not a per unit amount, it's a total dollar. So the cost per unit of output decreases as volume increases. And we'll go through some examples of that. In our graph here, we can see if 200 units are produced when monthly rent is $32,000, the average rent cost per unit would be $160. So that's $32,000 divided by those 200 units. When production increases to 1,000, the average rent cost per unit does decrease, but our overall rent is still that same $32,000. So that's what our top one shows, that their fixed costs remain the same no matter what. So we can see that as our total costs are increasing, our fixed costs remain that $32,000, even if they hit capacity during that month. The bottom part shows that the fixed cost per unit falls as production levels level out. So what we're looking for here is to find that relevant range for fixed costs, and here it's 0 to 2,000 units. So the relevant range changes, the amount of fixed costs is likely to change too. All right, let's look at our next type of cost. It's a variable cost. So variable means that it changes in proportion to the amount of volume that you have. So direct materials is the cost of a product would be an example of a variable cost. The more products you make, the more direct materials you need. So if you made less, you would need less direct materials. So it's in direct correlation with the volume of activity. Some other examples for variable costs besides direct materials could be direct labor, because if they're paid by the unit or by the hour. If you spend more hours, you're usually making more units. Sales commission could be a variable cost because it's based off of how much you sell. Shipping costs, and then there are also some overhead costs that could be included too. So one thing to notice though is that the variable cost per unit remains constant. It just changes depending on how much you make. That will be how we see those costs change. The next kind we have is a mixed cost. So with a mixed cost, it has a component of fixed and a component of variable. So it's not one or the other, it's a combination of both. So compensation for a sales representative typically has a fixed monthly salary that they're getting. And then if they do really well, they might get a commission based off their sales. So the salary part is fixed, the commission part is variable. So that means the overall would be a mixed cost. So another example sometimes we'll see with a mixed cost would be utilities. So even though like electricity, if you think about that one, yeah, there's typically, it's based on use. However, there is a minimum charge. So that minimum amount would be your fixed part. And then as you use more electricity, you have that variable amount that you pay per unit. So like a fixed cost, a mixed cost is greater than zero when the volume is zero. But unlike a fixed cost, it increases in proportion to the increase in volume. All right, let's look at our next kind. We have something called a stepwise cost. So a stepwise cost, it's also sometimes called a stair step, and you'll see that it looks like a stair step in the picture. And that reflects a step pattern in cost. So typically we see when you have like a production company, salaries of their production supervisors, we often see in the stepwise pattern, because if they are making, a certain amount of units, they might only need one production supervisor. But as they increase their workload and the people that are doing it, they may need a second supervisor. And then when they hit that next capacity level, they need the third supervisor. So it's a fixed cost and it increases based off of volume. Again, this is within a relevant range. So sometimes we might see, that as the volume expands, we need to add those additional people. So our total cost goes up by a lump sum amount, because remember, salary is the same amount all the time. So that extra person working is getting paid a salary. So that's why it ended up going up, but it's a flat amount that it goes up. It's not on a rising based upon volume. All right, when we look at cost value profit analysis, stepwise is usually treated as either a fixed or a variable. And the treatment involves typically a manager to make a judgment and depends on the relevant range and the expected volume. So if we think about it, in terms of the quantity changing, it's changing based off of that relevant range, and we might have to increase it as we increase that productivity. All right, our next kind is curvilinear cost. So curvilinear cost is where we have an increase as volume increases, but it's not at a constant rate. So it could go up, for a little while and it might increase, but it's not at a specific rate. So when we saw variable costs, they were increasing at a constant rate based on the volume of activity. And we looked at like sales commission as an example of that one. But with a curvilinear cost, it's not at a constant rate. So the curved line in the slide shows a curvilinear cost beginning at 0 when production is 0, and it increasing at different rates as volume increases. So an example of a curvilinear cost is total direct labor cost when workers are paid by the hour. So a company might add new employees assigned to specialize in certain tasks. So when production levels are relatively low, adding those specialized employees often yields more output. So we see that in the flatter slope of the curvilinear cost graph that's shown. However, at some point we may get to where we're adding more employees, and that would create an inefficiency. So they're kind of getting in each other's way. So that inefficiency is reflected in the steeper slope for the curvilinear cost graph. When we look at CVP analysis, curvilinear costs are often treated as variable costs, again within that relevant range. It's reasonable for most types of curvilinear costs. Okay, our next section, we're going to be looking at measuring these cost behaviors. So we're going to look at 3 different types. We're going to look at scatter diagrams, the high-low method, and then regression. So when we talk about cost behaviors, identifying and measuring these cost behaviors requires analysis and judgment. An important part of the process is to identify costs that can be classified as either fixed or variable. So we have to look at a past cost behavior to be able to tell that. So a goal of classifying cost is to develop a cost equation. The cost equation expresses total cost as a function of fixed costs plus the variable cost per unit. So there's 3 methods that are most commonly used, and that's what we're going to be looking at: the scatter diagrams, high-low method, and least squares regression. We're not going to get into a lot of that one. That's more of a statistical calculation, but we'll talk about it. So a scatter diagram is a display of past cost and unit information in a graph form. When we're preparing a scatter diagram, units are to be plotted on the horizontal axis and costs are plotted on the vertical axis. So each individual point on the scatter diagram reflects the cost and number of units from a prior period. So here's what one's going to look like. We can see that, we mapped it out. We have March. We have each of the months here. And we can see that, we're mapping out by the volume of units and the cost that went along with that volume. So in this graph, the prior 12 months cost and numbers of units are graphed. Each point in the green reflects total costs incurred and units produced for one of those months. For example, the point labeled March has units produced of 25,000 and costs of 25,000. You also see this orange line that says estimated line of cost behavior, and that's drawn on a scatter diagram to reflect the relation between cost and unit volume. The line best visually fits the points in a scatter diagram. Typically, again, that's a judgment call, but you're trying to get it as in the middle of all of the dots is what the goal is. Excel does it really easily. We're not going to get into the detail of that, but just so you know, you can do a scatter diagram very easily in Excel. So the line drawn at the graph intersects the vertical axis at approximately 16,000. So that's our fixed cost, right? Well, this is actually 17,000. So our fixed cost is 17,000. And for us to go to compute the variable cost per unit or the slope, we're going to perform 3 steps. We're going to draw the vertical line from each of the points to intersect the estimated line cost behavior. The point on the vertical axis is the cost corresponding to a specific number of units. In this case, it's 40,000. And we're going to find it typically is going to intersect at about the $24,000 cost. So if we use that as one of our points, and then we look at the cost corresponding to 0 units, that's around 17,000. So at 0 units, we have 17,000. That's our estimated fixed cost component. Then we're going to compute the slope of the line, or the variable cost, as the change in cost divided by the change in units. So our equation is going to show that calculation. Okay, our next one is going to be the high-low method, and we're going to continue that in the next video.